market borrowing rates, economic conditions, and WACC for a fintech investment firm. Welcome to Data Daddy's deep dive into corporate finance for a fintech investment company we'll call Vibe Tandem. This company is the parent to a family of services including digital notary, upload lab, virtual ecosystem, universal enterprise system, and a forward-looking artificial intelligence initiative. Today, we explore how market borrowing rates and U.S. economic conditions affect the weighted average cost of capital, or WACC, for a company like this. We'll also look at projected growth opportunities, stability risks, and how financial choices ripple out to customers, investors, partners, owners, and employees. Let's begin with the U.S. economy in 2025. After years of ultra-low interest rates, the Federal Reserve raised rates sharply in 2022 and 2023 to fight inflation. Corporate borrowing costs climbed. Even now, rates are high compared to the pre-pandemic years. For example, yields on investment-grade corporate bonds sit above 6% compared to below 4% just a few years ago. The forecast shows gradual improvement. The Fed expects its benchmark rate to drop to just under 4% by the end of 2025 and settle closer to 3% in the longer term. That means borrowing could get cheaper by 2026 or 2027. But for now, credit remains expensive, and most companies are cautious about taking on new debt. The economy is growing modestly. GDP growth is projected at about 1.5% in 2025, with unemployment around 4.5%. Inflation is easing toward the Fed's 2% target by 2027. This mix of slow growth but improving price stability means cautious optimism for business investment. Now let's look at the fintech sector itself. Growth potential remains strong. Global fintech revenues could reach $1.5 trillion by 2030, with North America growing in the double digits. Digital payments, online lending, and blockchain adoption are still expanding rapidly. But the sector has also seen turbulence. Rising interest rates and investor caution reduced funding in recent years. Some startups collapsed after burning through capital too quickly. For Vibe Tandem, these trends mean two things. First, growth opportunities are real if the company can scale effectively. Second, stability risks are high if capital is mismanaged or markets tighten further. A balanced approach to funding is essential. This brings us to WACC. Weighted average cost of capital is the average return a company must provide to both lenders and shareholders to finance its assets. It blends the cost of equity with the cost of debt, weighted by how much the company uses of each. In early stages, most fintech companies are funded almost entirely by equity. Equity is expensive. Venture capital may expect 30 to 50% returns due to high risk. That means a young company's WACC can easily be 30% or more. As the company matures, builds revenue, and proves its model, the cost of equity falls, debt becomes accessible, and WACC drops into the teens, or even single digits for established players like PayPal, which sits around 9%. For Vibe Tandem, early financing will come from equity. Debt should be introduced only when the company has stable revenues and a clear plan to use the funds for growth without over-leveraging. Lowering WACC over time opens the door to more projects clearing the investment hurdle rate, allowing faster expansion across its services. Financial strategy impacts each service differently. Digital notary might get priority if it offers quicker returns. Larger infrastructure investments like universal enterprise system could wait until the cost of capital drops. Shared resources like a unified backend can spread costs across multiple services, increasing overall returns. And every stakeholder feels the effects. Customers benefit when the company invests in better features without overpricing. Investors want projects that beat the WACC and grow value. Partners trust stable, well-funded companies. Owners balance growth with ownership dilution. Employees see job security and development opportunities when capital is used wisely. In closing, the 2025 environment presents high borrowing costs but steady demand for fintech. Vibe Tandem's mission is to navigate the early high WACC stage with strategic equity use, bring in debt at the right time, and steadily lower the cost of capital. This journey, if managed well, creates a cycle where lower WACC fuels growth, which benefits every stakeholder and strengthens the company's future. This has been Data Daddy's deep dive into fintech corporate finance. Stay tuned for our next analysis, where we'll connect financial strategy to real-world competitive positioning.